Hi folks and welcome back. In our previous videos we have learned about different ways of investing. In this video let's learn about one such way of investment. What is a mutual fund? A mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds or other securities. Mutual funds are a popular choice among investors because they generally offer the following features. Professional management. The fund managers do the research for you. They select the securities and monitor the performance. Mutual funds typically invest in a range of companies and industries in order to diversify the funds. This helps to lower your risk if one company fails. Affordability. Most mutual funds set a relatively low dollar amount for initial investment and subsequent purchases. Make sure you understand the fees as they can add up substantially. Liquidity. Mutual fund investors can easily redeem their shares at any time for the current net asset value. Active versus passive management. Active management. Active management is when the portfolio manager buys and sells investments attempting to outperform the return of the overall market or another identified benchmark. Passive management. Passive management involves buying a portfolio of securities designed to track the performance of a benchmark index. The fund's holdings are only adjusted if there is an adjustment in the components of the index. Different types of mutual funds. Most mutual funds fall into one of four main categories: money market funds, bond funds, stock funds, and target date funds. Each type has different features, risks, and rewards. Money market funds have relatively low risks. By law, they can invest only in certain high-quality short-term investments issued by U.S. corporations, federal, state, and local governments. Bond funds have higher risks than money market funds because they typically aim to produce higher returns. Because there are many different types of bonds, the risks and rewards of bond funds can vary dramatically. Stock funds invest in corporate stocks. Not all stock funds are the same. For example, income funds invest in stocks that pay regular dividends, but growth stocks focus on stocks that have potential for above-average financial gains. Index funds tracks a particular market index such as the S&P 500, whereas sector funds specialize in a particular industry segment. Target date funds hold a mix of stocks, bonds, and other investments. Over time, the mix gradually shifts according to the fund's strategy. Target date funds, sometimes known as life cycle funds, are designed for individuals with particular retirement dates in mind. Investors typically earn a return from a mutual fund in three ways. Income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Funds often give investors a choice either to receive a check for distributions or to reinvest the earnings, and get more shares. If the fund sells securities that have increased in price, the fund has a capital gain. Most funds also pass on these gains to investors in a distribution. If fund holdings increase in price, but are not sold by the fund manager, you can then sell your mutual fund shares for a profit in the market.